Major GST rule change. Starting 1st April 2025, businesses must use the Input Service Distributor (ISD) mechanism for input tax credit claims. Cross-charging will be banned. Swipe to learn how this impacts your business and what actions to take now. What is changing in GST? Effective 1st April 2025. CBIC has mandated ISD compliance for ITC distribution under Notification No. 16/2024 Central Tax. Cross-charging prohibited. The cross-charge mechanism for ITC distribution is no longer allowed. Non-compliance penalty. Businesses failing to comply will face ITC denial and a minimum penalty of 10,000 rupees. Who will be affected? The text discusses various types of businesses that operate in multiple states and utilize shared services, including multi-state businesses with GST registrations in several states, corporate offices that centrally procure services for different branches, and service providers like IT and consulting firms that have centralized expenses. It highlights the significance of being prepared for transitions when employing shared services across different locations. Understanding the ISD mechanism. This text outlines steps for a corporate office to register as an Input Service Distributor (ISD). It highlights the significance of ISD registration, processing input service invoices, and allocating input tax credits (ITC) to branches based on turnover or consumption. Additionally, it emphasizes filing the monthly GST-R6 return to comply with GST regulations. The ISD system offers a structured method for managing input tax credits across multiple locations, replacing the old cross-charging method. Why cross-charging is being eliminated? Preventing tax leakage is critical as businesses exploit cross-charging to improperly claim input tax credits (ITC). A standardized input service distribution (ISD) process ensures fair credit distribution based on actual consumption. Dedicated ISD invoices and returns enhance the audit trail, improving documentation for tax authorities. The government observes that preferring cross-charging over ISD registration has led to compliance issues and complicated audits. The new regulations aim to structure ITC distribution, enhancing compliance and transparency. ISD distribution rules. You must follow the same month distribution guidelines require allocating credits within the month received. All locations, including unregistered offices using common services, must be included. ITC allocation should be proportional to turnover ratios for multiple use locations. If a service is exclusive to one location, that location receives the full ITC. For forward charge services across states, CGST and SGST convert to IGST during distribution. For reverse charge services within the same state, CGST and SGST remain unchanged. Practical example, retail company before 1st April 2025, cross-charge, the Delhi office purchases POS machines and sends invoices, cross-charging expenses to branches. Each branch can claim input tax credit, ITC, to recover some taxes paid during operations. After 1st April 2025, ISD, the Delhi head office serves as an Input Service Distributor, ISD, receiving vendor invoices for services and redistributing input tax credit, ITC, through ISD invoices. It also files monthly GST-R6 returns to comply with tax regulations. This example illustrates a retail business transitioning from cross-charging to the mandated ISD mechanism for input tax credit distribution. Act now. Prepare for April 2025. The GST amendment alters input tax credit management. Actions involve applying for ISD registration, updating accounting systems, training finance teams, and reviewing contracts. Early preparation can prevent penalties, so share this with impacted professionals and businesses.